Who says lightning doesn't strike twice? Our next guest considered investing with both Raj Rajaratnam and Bernie Madoff, but declined each time, saving his clients untold millions. Fabio Savoldelli is Chief Investment Officer at Optima Fund Management, a New York-based firm that invests in hedge funds mostly on behalf of institutional investors. Optima has about $3.4 billion under management. Fabio is here with us on the Inside Track. So, Fabio, you're batting 1,000 in two of the biggest securities fraud cases of all time. What was it about the Galleon Group that didn't sit right with you?
You know, investing in hedge funds is both sort of an art and a science. And it's interesting. I think the Galleon Group really fell more in the line of the art. We had, in the case of Galleon Group, we had two very talented young analysts, Yehuda Spindler and Leslie Hill. Actually were invited to sit in on one of their investment management committee meetings where they would review in the morning meeting where review stocks. These happen at every hedge fund in the world. And fundamentally what I think went wrong there, the thing that stopped us, was not about the stocks. It was not even, you can't really sense if the information was inside, but rather it was about the corporate culture. The people involved, from Raj at the end of the table to one of the portfolio managers, one of the four senior portfolio managers, had created a culture that seemed basically almost abusive. They were yelling at the analysts, they were quite harsh on them, and part of the things that drives often good people to do bad things is in fact the culture in which they work. You want an environment where people are free to grow and that you're going to see them bringing their best ideas forwards. You can't pound it out of your analysts. And when you get that kind of environment, it's not one that is stable and it's not one that's replicatable or one that's going to continue for a long time. It's very flawed. So
most people think when you look at a hedge fund, and that's what you do due diligence on hedge funds in order to make decisions about where to put your clients' money. Absolutely. Most people think it comes down to looking at things like the auditor, things like compliance systems, things like custodial relationships with banks. In this case, what you're saying is you have to be not just look much deeper than that, but look at things on a completely different level. How on earth do you make decisions like that? Well, because you may be passing up. Let's say Raj wasn't guilty. You may have passed up an enormous investment opportunity. He had great returns for a while.
That's exactly right. And, you know, it is a good point. And I think the pendulum on the evaluation of funds had swung. After Bernie Madoff, people said, look, you know, it's the two accountants who were something of a joke in Florida. You know, it's the absence of an administrator. And as if you could tick boxes. And just by doing the back office due diligence, you could control the risks and capture the best hedge funds. The reality is that in the middle there lies the science. And also then you get about further on when you look at the track record. And again, you look at someone like Bernie's track record, and there's nothing there that would indicate should cause tremendous suspicion, but it's not on the face of it something that one would look at as being immediately incorrect. In this case, it really enters further on into the realm of art. It's not something that you can sit there and with a checklist and walk in and say, you know, is the environment abusive? Check. It's something that an experienced analyst would look at and get a feeling that, you know what, this is not an environment that's going to bring out the best in people, that's going to create excellent returns.
But many other investors, including other hedge funds of funds, took a look at the very same thing you saw at Galleon Group and saw, instead of an abusive situation, the one that you just described with these young analysts, they saw great research.
There is a line, and that really comes down to experience. You know, 20 years in the fund of funds business for Optima is really, you know, it makes a difference, and you can see the environments that work and the environments that lead to unsustainable sorts of situations. That was an unsustainable structure that Raj had created.
But the things that stopped you from investing in Madoff were not the same things that stopped you from investing in Galleon.
Not at all. Madoff, you didn't even need to go. First, there was no investment committee, but setting that aside, you really didn't need to get that far. If the science had failed you, if you had failed the back office, for example, an investor in one of the feeder funds would have seen a fund that was audited, would have seen a fund that did have an independent administrator. But nevertheless, by looking at the track record, by looking at what they were actually producing, and knowing how that kind of return would be made, you would know that split strike conversion couldn't possibly have returning those kinds of numbers.
So what does the guilty verdict specifically mean in the Raj case? Because there are many other cases that have yet to be tried. What does it mean for hedge funds? What does it mean for an investor like you?
I think it's going to clean up to some degree probably the voices on the tapes and things like that. But Raj is a fairly bright line case. When you're wiring from your offshore bank account $500,000 to the housekeeper of one of your sources in her offshore bank account, this is not a gray area. And that is a tiny, tiny percentage of hedge funds would even remotely have anything to do with it. Will there be some? Yes. There's guys getting up at 2 in the morning to shred hard drives, and they're coming to trial later. But the reality is that this is actually, for the majority of hedge funds, not something that they even go remotely near. Most of them are extraordinarily careful to avoid any of these sorts of things. There will be some structural changes. There will be some changes to funds that are most open and most run the greatest risk of having inside information come into the mix, to having a bad apple make a mess of the bunch.
Fabio, we were talking about the changes that the guilty verdict in the Raj case are going to play out in the hedge fund industry. You said some structural changes are in order. What do you mean?
Well, there's, many of the hedge funds are, can be smaller, concentrated groups of managers. But in other cases, you tend to have some that are called core book style, where you might have one central manager with many smaller traders, all of whom are given a small amount of money in relative terms.
And have to prove themselves to the big guy.
Have to prove themselves to the big guy, and their best ideas get into the big book. And that's how they get paid. They don't get paid that much based on their own trading in their book, but also mostly they get paid based on how many of their ideas get into the big guy's book. And that, I think, is a real risk, because now the big guy may be getting information and trading on information that he
not knowing how solid, not knowing how clean it is.
Not knowing how clean it is. And similarly, the young guy who's left his job as an analyst at this firm for this big shot at a hedge fund can find himself under a lot of pressure. And
encourages cowboy-like behavior.
It may not. It depends really on the controls and the characters and the kinds of people that you buy. The question is really span of control. How many people can you have out there that you as an individual can control without knowing that somewhere deep in the far corner you've got a problem?
Let's talk about the big case coming up, because as you pointed out, the Raj verdict actually isn't the big deal. It's the one on the horizon. It has to do with expert networks. Why is that such a big deal for hedge funds?
Well, in the Raj deal, it is something, as Doug and others have talked about, the absolute bright line. Don't wire people money for information in offshore accounts. It's, when you listen to the tapes and they're available, transparently clear. When you listen to some of the things on the use of expert networks, you listen to someone and they're extremely accurate one quarter. Okay. They're accurate the next quarter. They're accurate the third quarter. You're paying them. But at what point do you start to think, you know what, this is too good? It becomes a much grayer area. What if you've heard from, what if the expert network receives something 1 or 2 steps removed? I'm still in possession of inside information, but truly didn't know that it was information. That's where it gets gray.
And that ultimately is what a jury may have to decide. Fabio Savoldelli, Chief Investment Officer at Optima.